Jonathan, dude, great to have you on the podcast today. I appreciate you taking out the time and jumping on, especially the first of the year, really. And as we get everything in motion for 2023, I was interested to have you on, get your take. We were talking about real estate in our markets and niche markets comparatively to across the United States before we started recording. So before we get into it, can you tell a little bit of our listeners about yourself, who you are before you got into real estate and, what made you today who you are?
Yeah, of course. Thanks for having me, Pete. It's awesome to be here. I love talking about real estate. So I am really looking forward to this conversation. So I am a former special ed teacher. I taught special ed straight out of college for 8 years. I taught kindergartners through high schoolers. And it was it was a great experience, but it didn't offer me two things really that I was looking for: time freedom and location freedom. We need teachers. Teachers are super important, but it was ultimately just not where I saw myself long term. And so eventually I got into flipping houses and small multifamily rentals and into some bigger commercial stuff. And so that's where I'm at right now. I have a multi-million-dollar portfolio. Small multifamily rentals, some small commercial properties, and a podcast that I just recently started. So let me tell you about my first deal, though.
Yeah.
My first deal, I bought immediately after I graduated college. I graduated in 2007, and I was dead set on buying a fixer-upper property. I had no experience in real estate, but I was just dead set on doing this thing. I didn't know what ARV meant. I didn't know how to calculate rehab costs. All I wanted to do was buy a dumpy property, fix it up, and sell it in a couple of years. So that's what I did. So this was 2007, and I got a loan with my first job out of college. I was making $35,000 as a special ed teacher. And I got one of these ridiculous no doc loans with 100% financing. I think I even I even got money back at closing. I don't even know
Nice.
how that worked, but I got this ridiculous loan. And it was this condo I bought for $127,000. And I put a bunch of money into it, like $15,000, and did all this stuff to it. And then I wanted to sell 2 years later. And if you know anything about real estate history in the last couple decades, 2007 was not a great time to buy real estate. And then 2009, not a great time to sell real estate. And so I learned a lot on that property. I ended up losing money. I had to bring a little bit of money to closing. But that was my entrance into investing in real estate.
Well, no, I would say I feel like it was the right and wrong time to do it. You know what I mean? Like at least so for one, before we go into that full first deal, I mean, was that your first push of like, hey, I want to, get out of education and teaching, or was there motivation and then there was a search of where to go and then you found real estate?
That was me being a dumb 22-year-old who was stubborn, and I just wanted to do whatever I wanted to do. And
Yeah.
nobody was as smart as me. I know what I'm doing, and nobody can tell me anything. And so, I really had three big takeaways from that experience, and I still reflect on that today. So at that time, I thought I was going to be a teacher for the rest of my life. I had no idea what investing in real estate really was. I just wanted to fix up a place and live in it for a little while. So coming away from that, and especially reflecting on it, number one, I really thought about the importance of knowing your market. And so just knowing down to the details, either your town or even your neighborhood. What is the reputation? What's happening with real estate in that area? Number two, numbers don't lie. A lot of times when we buy these properties or we're looking at properties or underwriting, and we can kind of fudge some numbers and, oh, I think rents are, well, I think I can get a little more in rent, or like rehab. Well, my rehab isn't going to be that much. I'm going to reduce my rehab cost a little bit. And lesson learned, do not do that. The numbers don't lie. If anything, go the other way and be a little extra conservative with your numbers. And finally, as a dumb and stubborn 22-year-old, my lesson was don't be stubborn. So going back to the numbers don't lie idea, it's like if the numbers aren't working, and if people around you that are smarter than you and have more experience than you are telling you, hey, this is maybe not a great idea, maybe not this property, it's a good idea to listen to them, learn, and try not to be so stubborn.
Yeah, I agree with you. I mean, I think I was right there at that same age, 21, 22, where you felt like you were, for one, invincible. Two, anything and everybody that's telling you something, you go completely opposite. And you're like, yeah, I'll just do my own thing because I feel like I'm more accurate on what I depict is going to happen. And I didn't even hear what you said.
Right. And I think if I've got a message for people that are maybe just starting out in real estate now, or maybe have experienced some success over the last few years, it's don't be so stubborn, and, really listen to people around you that have been in the trenches. Because really, if you've been investing in real estate since 2012, you've seen nothing but ups, and it can be tempting to think that you're invincible, that I'm the exception, the rules don't apply to me, this is a different market, there aren't going to be any more real estate cycles, real estate is only going to go up from here on. And I think there are a lot of parallels to right now as there was in 2007. Not the reasons for the downturn. The reasons are totally different, but just the idea that we had some really good years, but the good years don't always last. That cycles in real estate are totally normal and they should be expected. And if you're going to be successful in real estate, you have to ride the cycles and know how to execute during the cycles.
Yeah, I agree with that. You definitely have to execute at the right time and, be able to manage on changing, times for sure. So were you a teacher throughout, 2008, 9, 10, 11,
I
12?
was. Yep.
Okay.
I was a special ed teacher. I took a break from teaching for a period and got involved in the non-for-profit world where I made even less money than I made teaching, and then got back into the teaching world. And then ultimately, at the end of the 2018-2019 school year is when I called it quits. And I had a plan. It wasn't a situation of I'm burning the boats, I have no plan, and I'm just going to go into real estate full time. At that time, I had successfully completed a few flips. I had a few rental doors in my portfolio, and I had a runway fund. So Scott Trench has a book about quitting your W-2 job, and it's called Set for Life. And so,
Hmm.
like, how do you build your life around this idea of setting yourself up for success long term? And one of the ideas and concepts in that book is having a runway fund. And so that's what we did. I was married at the time. I still am married. And so we just had 12 months worth of expenses saved up. And so we completed a few flips, put some money in savings, and we said, let's try it for a year. And really took the Tim Ferriss advice of considering, well, what's the worst that could happen, and actually writing out what's the worst that could happen. I quit my job, and then if we don't get any more deals, well, then we use some of our money in savings to provide for our lifestyle. And then eventually, if that money in savings runs out, well, what am I going to do? Well, I still have my degree, I still have my teaching certificate, I can go back to teaching. And so is that really a worst case scenario that I just go back to teaching? And so the story up to this point is that I have not had to go back to teaching, and
That's
that
good.
so that that strategy worked out well for us to this point. And So yeah, I am not a burn the boats kind of person. I am not a take massive action and do crazy things kind of person. I am a calculated risk taker. It is okay to take risks. It is okay to do things that are a little out of your comfort zone, but you should definitely think about it and calculate what could and couldn't happen.
Well, I mean, to that extent, which I can see how you are calculated with, having the runway fund or, emergency fund or, what type of fund you're going to have to be able to sustain, for a year or 6 months or 8 months, however you want to put it, especially with your family and what your comfort level is. But you coming from a W-2 background, that still it gives a lot of people that are naysayers saying like, well, you're still doing something crazy. You know what I mean? Like, you're not going to have a consistent paycheck. You're not going to be able to, bring in the same money you are, here at the W-2 or more money. So how'd you at least manage that with, working each and every, I would say conversation with people that you knew?
So if you are, yeah, if you're, I know there are people out there that are like, man, I really hate my W-2 job, or I'd love to be an entrepreneur. I'd love to go into business for myself. I think that's great. And I think it's definitely possible for you to do it, but you need to have a strategy and you need to think it out. So for me, it was having a runway fund. It was also having some passive income before quitting my job. So I didn't go from, I think, when I was teaching, I think I was making $65,000 a year my last year. So I didn't go from making $65,000 a year to zero the day after I quit. I still had, I already had some passive income built up. And so I knew it was possible. So, yeah. And so if you are, I would say you need to closely analyze what stage of life that you're at. If you are like 21 or 22 years old, freshly out of college or freshly out of high school, and you literally have nothing to lose, then it's probably a little more okay to take bigger risks. But if you're responsible for other people in your family, if you're married, if you have kids, maybe not a great idea to burn the boats and quit your W-2 job and go into an entrepreneurial venture where you have no income currently. So going from a large income to $0 when you have other people to care for is probably not a great idea. And so, you asked about conversations, and my dad was a teacher. That's probably a big reason that I initially went into teaching. And so I was brought up not as an entrepreneur. I was brought up being taught that safety and security are the most important things. That the yeah if there is any chance of failure, if there is any risk involved in a decision that you're going to make, you should not do that thing. And so, really, up until my mid to late 20s, that's the mindset that I had. But then it was gradually going into the entrepreneurial world. So, doing the first couple flips, the first flip was scary. I had no money to my name, and so I borrowed money. I took out balance transfers on credit cards. I borrowed from some friends that were involved in real estate. And so that was a scary thing. But I had listened to enough podcasts. I had read enough books to know that, the numbers on this particular deal made sense. And there was very little downside to this particular deal. And so I went ahead with it. And so it was a gradual shift. Like I said before, I am not big on burning the boats and taking massive action. I believe in taking small, consistent action. Take those small baby steps in the direction where you want to be headed. And that is ultimately going to lead you to greater long term success than potentially taking massive action and risking massive failure and having significant discouragement and not proceeding on that path. So taking those small steps has been really crucial on my journey.
Yeah, I mean, I think you hit the nail on the head with that. You got to make sure that you're taking action, it doesn't have to be something where you're buying 50 units, within a quarter, but, you're buying a single family a year until you can buy two a year, until you buy three a year. And then you build up that cash flow, or, you do a couple of single families, do the burr, and then ultimately move that money into a bigger multifamily, and then you consistently do that. So you don't have to. Sometimes you see these people that have done a lot of things in a short amount of time, and sometimes and I think for me, it definitely, like, how I look at it is people that all of a sudden look at those people that have done a lot of things in a short amount of time, become more discouraged than, become even more motivated, because they say, well, I can never get there, and that sometimes, is hard for people to see that massive action and be like, well, I only bought one property in the last 2 years. It's like, well, you're way ahead of, the curve, to be able to do that.
Yeah, absolutely. And, with social media, it is really easy to take a look at people doing big things. Um, but you just have to remember that people on social media are putting their best foot forward. And in most cases, they're making things look a little more rosy than they actually are. I look at a lot of syndication deals, people syndicating large multifamily complexes of 100 or more units. And it's been really popular in the last several years. There are all kinds of coaching programs, all kinds of podcasts for people to learn about multifamily syndication. And there are some people with zero experience trying to syndicate 30 or 40 $1 million deals, or even more. And I think that's really scary to me when I see people running webinars that are really young and have no experience. They've never even owned a duplex, or they've never even owned their own property, and now they're trying to syndicate a multi-million-dollar property. And so, I would my advice for people learning about real estate and trying to get into real estate is to take that small, consistent action. Don't get don't get rosy-eyed from people doing the huge deals. The people that have been successful doing huge deals have a team around them, have had a lot of experience doing smaller deals. You learn a lot from those smaller deals, and I think it's common for people to say, people of large syndications that have maybe experienced some success, to say things like, well, buying a big deal is the same amount of work as buying a small deal. And I really push back against that, because there's a lot more that can go wrong in a large deal. If you're buying a deal, a commercial property or a multifamily property, let's say of $1 million or more, let's say it's a 6-unit property of $1 million or more, there's a lot more that can go wrong in that particular property versus buying a duplex for $200,000. If your rehab numbers are off, it's magnified on a larger property. If interest rate fluctuations happen, it's magnified more with a higher dollar amount. And there's just more that could go wrong, particularly if you don't have the experience with smaller properties. So there is nothing wrong with starting with smaller properties and then scaling up.
Yeah, no, I agree. So I actually, speaking of syndications, I got a buddy of mine that, as you say, like, a lot of things can go wrong, and it's scary that people are doing, that are operators, have 3 years in the business, or 5 years in the business, and that's exactly what happened to a buddy of mine. Won't disclose his name or anything like that, but he was in a syndication. They bought a multifamily in Austin, and I think it was like 30 units, roughly 35 units. And he had some other friends and family get in on the syndication too. Well, there was a fire that had ripped through 75-80% of the property. So, and how they structured the debt was in a scenario where they tried to get the rehab costs from the bank to rehab it, and the bank wouldn't allow them to basically rehab it because they saw how the debt was structured on it when they purchased it, and they didn't have confidence in the operators and also the property. So they weren't able to do anything. So everybody, and this property was purchased, I want to say 2 years ago, year and a half ago, 2 years ago, and everybody's losing in the deal. Like everybody that has put anywhere from $50 to $100,000 into it are losing their money, and they're not going to be able to get it back. And the operators, one had like 3 years experience, the other one had 5. And I say this more of like, yeah, you got to be cognizant of who you're, for one, investing with, and two, and I'm not blaming my buddy because he wasn't the operator. He vouched for these people because one of the operators that was a partner in it was, I think, had like 7 or 8 years in the business, so he had more, knack for it. But now the operators are willing to basically lose their reputation and move on to other things because they can't just service everybody that had put money in. So those types of things do happen, and they are real. So you definitely have to vet the people that you're going to jump in with, and also vet the deal to yourself.
Absolutely. And I think it's going to be really interesting to see what happens over the next couple years, as there were probably some operators in the multifamily frenzy over the last few years um, doing some things that were maybe not wise, just
Mhm.
in terms of the type of debt they were taking on, the structure of the debt, the cap rates they were purchasing at, the underwriting involved, how they were projecting to exit the deal, whether through a sale or refinance. So I'm certainly not projecting a bloodbath or anything like that, but
No, yeah.
I think I think it'll be really interesting just to see as some deals mature, maybe from 2 or 3 years ago, and financing comes due, to see what happens if we start seeing some deals on multifamily properties, or if those operators are able to restructure and refinance at debt and terms that make more sense. Because I think there were, especially in places like Austin and Phoenix and even the Southeast, there was massive competition for some of these deals. And I think there were probably some operators that might end up looking back on purchases and maybe regretting or rethinking some decisions that were made.
Yeah, no, I think, yeah, I agree with you. I don't think there's going to be a bloodbath. I don't think it's going to be, 2008, 2009. I think that, a lot of people have backed out of deals, and I think that this is more of a adjustment that's happened already. But, people that were interest only loans that were in deals and stuff like that in escrow, a lot of them have fallen out because those interest rates went up so high. And so they had to back out. But, yeah, I think that it's just going to be, you got to keep your head on a swivel, especially these days. So you got to vet the deal. You got to make sure it doesn't matter if it's a multifamily syndication or it's, a single family that you're going to buy for yourself as a flip, or a wholesale deal. So, leaving the syndication route, what are you currently doing? What does your business model look like? And how are you getting deals today?
Yeah, so I have a portfolio of small multifamily properties. Um, I've had most of those properties for several years, and I'm also now getting into some commercial properties. And so I own a small commercial office building. Also looking at other triple net properties, things like industrial, medical, and retail. Um, right now, I feel like the best way to get deals, and I felt like this for a while, even when the market was really hot, it was relationships. I think just nurturing relationships is going to be your key to success. And so, if you're looking for, especially for multiple properties, if maybe maybe you know of a property manager in town who has 50 properties that he or she owns themselves. Those types of people are going to be wanting to sell eventually. Maybe you have a commercial lender who does a ton of deals in town, and some of those deals might be maturing right now. And so it might be a good time to reach out to some commercial lenders and just say, hey, I've got some cash. If any of your deals seem to be coming due and you don't think the current owner is going to be able to perform, let me know. I've got some cash and I'm looking to deploy some cash. Continuing to network with brokers. I think brokers and agents, they are on the front lines. They know what's happening on the front lines, and they know what's happening with their sellers. And so let's say you're looking for your first single family rental, or you're even looking for a single family residence for yourself, and you've been looking at some properties and they've been sitting on the market for a while. Might be a good idea to just continuously check in with that agent and just say, hey, I see this is sitting on the market for a little while. It's higher than the average days on the market. Is there something going on with this property? Whenever I look to buy real estate, I'm always looking for some sort of distress. So it could be a funky property. It could be something wrong with the property. Or there could just be distress with the seller. Maybe the seller's passed away and it's an inheritance and the family is now taking care of the property. Anything like that, I'm looking for value. So when I buy properties, I'm not paying market rate. I'm not looking at what the market is doing and paying top dollar. I'm looking for some sort of deal. And so in this market, it's based on relationships. And it also might be a matter of making offers. So right now, if you see a property that looks attractive to you, we talked about this before we hit record, but it might be a good time to start making some offers that 6 or 12 months ago you thought would be unrealistic and maybe was unrealistic at that time. But right now, sellers might be entertaining things. You just don't know what a seller is going through in their life or what their mindset is. That seller might be watching the nightly news and thinking the sky's falling, and the longer they sit on this property, the lower the value is going to go. And so, there might be sellers that are really freaking out right now. And so, if you come with a low offer that has some concessions, you might be able to get a pretty good deal that in 5 years from now you're going to be really happy you got into.
For sure. Yeah, I agree. There might be, and to second that thought, including how you look at the deal. If you're in a deal and you walk away because it's $1,000 or $500, I've seen that happen too. Or a couple of my transactions where the people are like, "Yeah, we just can't meet on it, so we're out," or whatever it may be. Those are also on the flip side. If it's $50,000 or $60,000, yeah, I would walk away if that's gonna, not happen for you. But if it's a small nominal amount, even if the property is $300,000, I think you really got to crunch the numbers again to see if you got a good reduction in price, you get some closing costs back, and maybe it's a reduced interest rate. Really go back to those people and say, hey, listen, we're here, we're willing to get this thing closed. And we're motivated, and it looks like you are too. So yeah, on the flip side of that, I agree, pursue those ones that have been listed for a while and or condition isn't as good, and pursue those ones that maybe you think you're just going to walk away from, but it's only, $2,000 away.
In this market, as we talk in January 2023, it is really important to have a long-term view. So you asked before what kind of deals that I'm buying right now. I am not buying flips right now. The market is just too uncertain. If I were to buy a flip right now with the intention of selling it in 6 months, there's no way for me to predict what the market is going to look like in 6 months. So I'm simply not buying flips right now. That's not to say that it's impossible to make money flipping houses right now. I'm sure there are people doing it, but I think for most people, it's not wise. And so the properties that I'm looking at are properties that I see myself owning for 5 or more years. And so this is not an invitation to buy bad deals. You should not buy bad deals. But if you're intending to hold a property for 5 or more years, that means you've got favorable debt on it. That means your debt isn't going to mature for at least 5 years. If it's a rental property, that means you feel pretty good about the prospects of rents increasing over the next 5 years. Rents may not increase in the next 12 months, even the next 24 months, but in the next 5 to 7 years, yeah, rents are probably going to be higher than they are right now. And then, of course, the three rules of real estate: location, location, location. So if you feel good about the location of that property, where you feel like you have multiple exit strategies, where you feel good about the prognosis of the market, you feel good about the direction that rents are headed, if that's your strategy with it. I don't think there's any issue in buying real estate right now, but you do have to be smart about it and have a plan.
Yeah, no, you definitely have to have a plan. I like your strategy is, you're gonna buy something that you're gonna hold 5 plus years. It's the same thing as like like a mutual fund. You gotta a lot of people say like, well, I have $100,000 in the bank. I don't want to buy something here in the next like 2 or 3 months. So where can I put my money and I get a 6, 9% return on it, or even 5 or 4% return? Um, well, you can do that with flips, but obviously right now the market's changed. And then two is you got to look at something that you're going to be able to be vested with, just like syndications, for a few years, at least 4 to 5, where you're committed on that money. But if you want that money more liquid, you got to sit on it for a while, and then really design your plan towards a property, multiple properties that you're going to go in on, or go with some investors.
Yeah, absolutely. Real estate is a long game. And I think a lot of people and investors, we got anchored in some unhealthy attitudes and thoughts about real estate over the last 18 months, where, I mean, we all remember what was happening in 2021 and the early part of 2022. And some of us got anchored in the idea that that's what real estate is, and that's what we're going to expect from real estate moving forward. And we have to remember that 2021 and the early months of 2022 was an anomaly in the real estate market. That is not that is not the norm. Historically, that is not the norm. I'm not going to pretend to predict what the future is going to hold in real estate. There's still clearly a demand for housing, but I think expecting to go back to 2021 days and 3% interest rates, that's just not good underwriting. That's not good projecting. And so when I'm underwriting and projecting my deals, I'm looking at historically what's been happening in real estate. What's the trajectory of the market in which I'm investing, and make good decisions from there. I'm not basing my current decisions thinking that 2021 is going to happen again. It very well may, but if I base my numbers and projections based on 2021 happening again, that's probably a recipe for losing a bunch of money.
Yeah, for sure. Definitely a recipe for losing a bunch of money if you think that, prices are still going to go up, or there's, going to be a ultimate change in the market and continue to go up, or, you buy something thinking that the ARV is going to go, 15, 20% above, where it's at now. You got to really be cautious. A lot of real estate investors that are doing flips have pulled all their money off the table for flips, unless it's a significant amount, reduction, 40% off what their ARV is, 32, 35% what the ARV is. So those are things that people are looking at, and especially what the length of time to hold it to rehab it. So if it's a property that's had some fire damage, they're probably gonna walk away from that one unless they get a steep discount, or if the property just needs some paint and a couple other things, they'll probably go after it if they get a fair price for it. How are you getting your deals today, Jonathan?
So it really comes back to relationships. I'm continuously looking at mostly at commercial deals right now. So there's a mastermind that I'm a part of. And so I network with other people in my mastermind. And then I'm also talking with brokers. So in the commercial world, I'm talking like the non-residential world. There's some websites like LoopNet and Crexy. And the majority of those deals are they're not high cash flow deals. They're not high upside deals. But there's some strategies that I utilize using those websites, like looking for brokers with lots of listings. So if I see a market that I like, I get on an email list so I see lots of deals that are coming up in that market. So let's say I'm looking for medical office space in Dallas. And so maybe every day or every week, I get a list of properties that meet my criteria in that market. And I start to see the names of brokers that are coming up continuously. And that's a good sign for me. That tells me that that's a broker that is well connected in the community that I want to be buying in. And so that would be I'd start making phone calls to that broker and saying, hey, these are the types of deals that I'm looking for. This particular deal, I see you have listed. This is what I like about it. The cap rate is just a little too low for me, and the location seems a little goofy. Do you ever have deals come up in this submarket or in this cap rate range? And so brokers are looking to make deals. Brokers right now are happy to have those conversations, and you'll probably start getting some emails from that broker. And it's just about nurturing relationships. I'm not buying deals off the MLS. I'm not buying deals from wholesalers. Deals are coming as a result of nurtured relationships. Sometimes it's a result of continuous contact with a broker. It's maybe following up with a broker who has a listing that has been hanging around for a while, seeing if anything has changed with a seller, and just continuing to nurture those important relationships with people who have access to the deals.
Yeah, for sure. Yeah, I think relationship game is one that goes very long and consistent for years and years. And talking about the downturn, or any type of downturn or change in the market, really solidifies those relationships even deeper.
I have done in the past when I was seriously doing flips and looking for single family stuff. I've done direct mail marketing. I've done advertising on radios. I've done radio commercials. I've done TV commercials. I've been that guy that you see on TV looking for flips. I'm not looking for flips right now. It just doesn't make sense. That's not to say people in that world can't or aren't making money, but for me and the size of my portfolio and where I'm at with my net worth and the amount of capital I have available, it's just not worth the risk. You had mentioned earlier, like, there could be some opportunities if you see like potentially a 40% discount. So if you get some ridiculous deal, I would say, go ahead with it as long as you have multiple exit strategies. If you have a property in a fantastic location and you find this amazing deal, I do some work in a resort area in Colorado, and in the last 6 months, I've been able to get some deals that are right on the mountain. It's a ski resort, and so I've found some deals that have been ski in, ski out properties. I'm going to do just fine on those deals because the location is so good. There are other places in that town that I would not buy that same deal because, if the location just isn't special, then I would skip over that. But I knew, when I saw these deals, I'm like, oh my gosh, this location is amazing. I know there's going to be demand for it. And that particular market, while not as hot as a year ago, that market is still doing fine. And I'm going to do just fine on those properties. And so just continuing to be calculated, I think if you've got a can't miss deal and you've done your underwriting and you feel good about it, go ahead. I don't think it's going to be a bloodbath, but I think it's important to be really certain about your numbers right now.
Yeah, no, I agree. You got to be certain about them. You got to know them. If you have a great opportunity, then I would say just make sure that you're either seasoned or you're working with someone that's seasoned that feels comfortable too with the numbers. Um, what's your so I know your strategy right now is buying properties that are you're going to hold for at least 5 years. What do you kind of see your goals and or business plan for 2023?
I really like the non-residential commercial world. And so that is something that I'm really doubling down on right now. The reason I like the commercial world is a couple things. First, I was just not getting the returns in the multifamily world that I was looking for. So basically, my bare bones is I'm looking for a minimum of 10% cash on cash returns. And when I was looking at multifamily deals, I was just not going to be able to get that. And that's 10% year one, right away. It needs to cash flow. I'm in the wealth building stage, but I'm also trying to build my cash flow still. And so I can't afford at my stage to put money into a deal or put investor money into a deal and not get a return back. And so I'm looking for opportunities outside of multifamily. I still love multifamily. And if I were to find a deal that cash flows, I would still buy multifamily for sure. But I've just decided to focus my efforts elsewhere. So on things like, I mentioned before, like a medical office building. So I really like the idea of triple net properties. And if your audience isn't familiar with triple net, nets are in the commercial world, taxes, insurance, and common area maintenance. So these are properties that you might see, like, say, if you see a Walgreens on the corner, that is almost certainly a triple net or even an absolute net property where the tenant, not the landlord, but the tenant, Walgreens in this case, is paying the taxes, insurance, landscaping, snow removal, roof repairs, HVAC repairs. The tenant is responsible for all of those things. And so it's ultimately, it's mailbox money is what it is. And so in the commercial world, there are value add opportunities. And so I'll try to keep it short, but I'm looking for value add opportunities in the commercial world. So if I'm looking at a medical office building, it might be a vacant medical office building, or it might be a medical office building where there's a physician there, but they have a lease that's expiring. So in the commercial world, the way you add value is by extending the lease. In the residential world, leases are generally 12 months. In the commercial world, leases are much longer. Sometimes in the medical world, they could be 5, 7, or even 10 years. And so if you purchase a property that has maybe 1 or 2 years left on the lease, that's going to be priced at a lower price point, a higher cap rate than a property with a longer lease. And so one value add strategy would be to look for properties with expiring leases and either extend the lease or wait for that tenant to move out and get a new tenant in there to get them on a longer lease. That's how you add value in the commercial world. And so it's not easy. It can be higher stakes, and it takes longer to find a commercial tenant than it does a residential tenant. When I have a vacancy in my multifamily properties, I can generally find a new tenant. I can have a new tenant in there within a few weeks. But in the commercial world, it could take a few months or even a year or more. And so you have to be prepared for that. So I'm looking for value add commercial properties in 2023.
Okay. Yeah. No, good. I mean, as you got into it, obviously you built up to, where you're at today to be able to look for triple net deals, commercial value add deals versus, something that was a quick and easy rental, flip, single family. So, um, you know, going forward, being conservative on those two really helps out the game plan for 2023 and 2024 for sure.
Yeah, absolutely. And
Uh,
I'm not buying just anything. It's got to pencil out, and then the numbers have to be really good. And yeah, I mean, I am buying in 2023, but I'm certainly not desperate. I'm erring more towards being cautious and waiting to see what happens versus being aggressive.
yeah. Yeah, yeah, for sure. No, I agree 100%. You definitely got to be cautious. You got to be conservative in these changing markets. Well, Jonathan, so moving forward to kind of our last segment, one thing, I mean, you've been successful in being able to be an entrepreneur and running, your own business, and also being able to buy existing properties, either fix them up and flip them, and or hold them for a extended period of time. Is there an app or an online resource that you use that makes you more efficient?
Yes, Monday.com has really helped my business over the last several years. So if listeners are not familiar with Monday.com, it's basically a project management tool. We use it to manage. So let me give you an example. So let's say we have a property that's under contract. When we have a property that's under contract and we're heading towards close in 30 days, in our project management software in Monday.com, we have a list of about 75 things that need to happen in order to get to a successful close. That ranges from getting lending squared away, if we have any private investors, getting them up to speed, getting utilities ready, getting insurance. So all of these things, if we have to start a new LLC, getting that going. If we're buying multiple properties at a time, it's really easy to forget stuff. And so Monday.com is a tool where we can have these 75 items listed out, essentially a checklist. And you can assign due dates for it. You can assign different team members to a certain task to take care of a task. And so you have everything in one place that needs to get done, and you can see the progress that you've made towards getting those tasks done. So Monday.com has been really helpful for us. It just helps us systematize everything.
Yeah, for sure. No, I use Monday.com. It's a really good tool, especially team members and stuff like that, to be able to, harness them, instead of herding cats, you're able to really keep them in there. So, okay. And what about a book? You mentioned Set for Life by Scott Trench. Is there any other book that's helped you along your path of where you're at today?
Yeah. So a recent book that I read, this is not particularly real estate related, but it's really related to high achievers. It's a Tim Ferriss book called Tribe of Mentors. And this is a giant book. It's one of the longest books that I've ever read. It's like 700 pages long. And, Tim Ferriss, by this point, he has this massive network of millionaires and billionaires that he can go to. And so he asked his network, it ended up being over 100 different people, really high achievers, just this list of 10 different questions. And they didn't answer all, not everyone answered all 10 questions, but they answered some questions, and you just get some amazing insight from these really high achieving people, both in net worth and just in physical accomplishments and life accomplishments, to get an idea of how they got to where they've gotten. So Tribe of Mentors would be one. The other one would be a book called The Gap in the Gain by Dan Sullivan and Benjamin Hardy. They are probably better known for their book, Who Not How. I hear that book all the time. But I don't hear people talking about The Gap and the Gain. And this is the premise of this book is essentially to make sure you celebrate your wins. Is that as high achievers, we set these goals, and then a lot of times before we even reach the goal, we have an even higher goal. And before we get to that goal, we have an even higher goal. And we don't ever take a step back and look back at where we've been and celebrate and respect the progress that we've made. And so The Gap and the Gain was one of my most important reads of 2022, and I'd highly recommend that.
Yeah, that one's good. I like that one a lot. I read Who Not How too. That one's really good as well.
Right.
Okay, so how can people find out more about you? I know you got a podcast, so
yeah. Yep. The best way is for people to check out my podcast. It's called The Source of Commercial Real Estate. And on that podcast, I have just experts from all areas of commercial real estate come on. I talk with brokers, investors from retail, industrial, quick serve restaurants, gas stations, office, all different asset classes. And it's really designed for people that are discouraged in the multifamily space, that are curious about commercial real estate, but aren't quite sure about how to get into it, how to learn about the different asset classes. We go over all the different asset classes and really just try to bring value to my listeners.
Yeah, that's huge. I mean, I just heard a stat the other day. It was like 90% of podcasts have like one episode and that's it. Like
Yeah.
they did everything and they posted and that's done. So, if you're above that, you're in the 10 percentile.
That
Uh,
I've done more than one episode, so
no,
sounds like I'm in good shape.
Yeah, you're in great shape. So good, man. Well, I'll put that in the show notes too for everybody that's listening. But I really appreciate, Jonathan, for you to come on and actually share your story and be able to give some insight on what the market's doing today, especially, across the board. Not just I do a lot of single family, but not just in single family, multifamily, triple net, everything else. So I appreciate you coming on and being vulnerable.
Cool. I appreciate the time, Pete. This was really fun.
Yeah, man. Thanks, man.
All
I'll
right.
talk to you soon.
Take care.